Hi, everybody. Thank you so much for joining and what is a very volatile, very, very news-heavy day. We saw a slow start to stocks. They did sell off at the start, but that has really gathered pace. Now I'm going to get straight into it. It is all about Trump's tariffs. They have absolutely upended prospects for growth in the global economy, what this means for global trade, what it means for geopolitical relations. We're seeing the end of American exceptionalism unwind incredibly rapidly. Now, I'm going to show you my charts on Bloomberg. And this just shows you global equity markets. Now, there's a lot of detail in there. There's a lot of things moving. But as you can see, it really shows you that it's just a sea of red. If you look at the 6th column in from the left, you'll see the percentage daily change. And we have a near 4% drop for the Euro Stoxx index, just over 3% drop for the FTSE 100 as well. So really playing catch up with the size of US drops that we saw yesterday across the S&P 500, across the NASDAQ, but also in those smaller mid-cap stocks as well, like the Russell 2000. The Russell 2000 is actually in a bear market, is down 20% since its peak in November. We've seen the S&P 500, they are down now 14% for the NASDAQ. So really hovering around that level of bear market territory, 8.25% for the S&P 500. Now the FTSE 100, some people are saying, well, hang on a minute, the UK is not impacted by all these tariffs. Well, of course they are, because it's a global economy and we have a lot of global supply chains here in the UK, but also it's because of what's going on with the oil price. Now, just bear with me, guys. I'm just going to switch over to show you what is going on with commodity prices. Now, if you follow my arrow, that's Brent crude. It slipped below $65 per barrel. It is down. It was down about 8%, so it's now down just under 8% on the day. So massive, massive moves. Also, keep following my arrow down. I'm just on the gold price now. It's currently trading at $3,097 per troy ounce. That is down $17 to $18. So essentially, weakening economic growth means that there's kind of no need for gold as an inflation hedge. So that's taken the froth out of the gold market. But it's just a sea of red. Look, every single commodity that is listed on this commodity index, and it's a hell of a lot, guys, they are all in the red. So all of the agricultural commodities, all of the metals, all of the energy. You rarely see this happen. When it does happen, that is usually around massive growth fears. So the last time we saw that was with COVID. These moves are COVID size moves. Now, I want to show you some as well. I'd like to show you some VIX. So remember, this is Wall Street's fear gauge. This is the maximum chart, goes all the way back to the 1990s. If you look on the far right-hand side of the screen, this is where we are today, trading just below 40, highest level since COVID. And to be honest, in the last 30 odd years, 35 years, we haven't had many spikes at this level. So you've got one now, you've got one in the COVID period, you've got one in 2011, that was the sovereign debt crisis. Obviously, you've got 2008, 2009. So we're heading up towards those levels. Lots of fears now, lots of fears out there about credit spreads blowing out and what this means. And we were trying to figure out, well, what does that mean? What could stop all of this? Because at the moment, it's not showing through to the hard economic data. And we're talking about that in a few minutes, because obviously we'll be looking at the non-farm payrolls. But what it does mean is that this huge amount of expectation that Donald Trump and his tariff plans have just torpedoed the American economy. Now, we really saw stocks start to sell off on the back of news that China had retaliated. We haven't even heard from the EU yet, but they've retaliated with 35% tariff on all US goods going into China. So that's, it really is tit for tat. And it seems like it could get even worse. So there's a lot of negativity out there. Now, yesterday, you might have followed what we were saying. You might have read our notes as well. We had historic size moves compared to the norm for the S&P 500. If you're into standard deviations, the S&P 500 had a 5 standard deviation move yesterday over more than the last 12 months. So that was really, really rare. And you can probably see it in the VIX index there. Now, this is the dollar index. Now, this is just what it's doing today. Remember, yesterday, the dollar absolutely fell so sharply. It's already the weakest currency in 2025. And we saw these big moves lower in the dollar. At one point, the dollar index, which is the dollar against a basket of other currency, of other countries and currencies based on its trading partners, ironically enough, had fallen at intraday at one stage to by its lowest ever level, by the biggest the biggest drop ever, which was more than 2%. Now it closed down 1.5% today. Now 1.5% yesterday. Sorry. Now today it had been rallying, so we had seen the pound come back, we've seen the euro come back, but then when those China announcements more about the tariffs were made just after 11 o'clock, we saw the dollar pull back. The euro was able to pick up some strength. As you can see here, this is just a daily chart. So what the euro is doing today, it's currently trading around 110.68. I'm just going to pull up a year chart for the euro so that you can see how that's playing out. Now this is a daily chart. So yesterday's daily move, just look at the length of that candle here where I'm kind of tracking with my mouse. If you just look at that's almost unheard of. So these are big standard deviation moves, and we saw a massive move higher in the euro. We got to as high as 111.50, so we were edging towards that 112, and then obviously some of the sellers came in, and today we really don't know what we're doing, and that's pretty similar story for the pound. Again, it's picked up off the low, but not by much, because remember the pound is getting a bit hammered as well because the FTSE is coming under so much pressure. But it's not just the FTSE, it's also this. So this is bond yields. If you look at the change in bond yields, so round about where my arrow is here, we're seeing a massive decline in bond yields across Europe and in the US, and we've seen that 10 basis point drop in 10-year yields in the UK. Now let's switch that to 2-year yields. Again, another 10 basis point drop. So again, actually bigger drops for the Eurozone because there is a massive rush towards central banks cutting interest rates just to help this. Now, some people have been saying, when will we get a recovery? What will that look like? At the moment, it looks like a lot of these stock markets, they're falling so precipitously. I'll just put us on that stock page that it feels a bit like catching a falling knife. Now, there definitely will be buyers coming in because some of this will be crazy. Yesterday, the S&P 500, Dell fell by 20%. Dell, obviously massive. I'm conducting this on a Dell laptop, massive computer company, huge firm, and its stock price fell by 20%. That's because it makes a lot of its components and lots of its laptops and other products in highly tariffed countries in Asia. So that's why it came under a huge amount of pressure. Are we going to see that again? We're going to be watching very, very closely for that. Likely, we saw, likewise, we saw Apple fall 9% yesterday. We saw Nvidia down over 6%. These a couple of reasons for that. Firstly, Apple has a very Asia-heavy supply chain. So it had moved production from China to Vietnam. Vietnam was obviously targeted by tariffs this time round. So that's why Apple came under so much pressure. About 250 billion just wiped off its market cap yesterday. It probably will be more today. Why did Nvidia come under pressure? Well, the AI theme is really taking a hammering now. It's been obviously under a lot of pressure all year since DeepSeek, but we've also seen so Microsoft announced they were going to scale back some of their investment into data centers. And that's the fear now, that if global growth, if the bottom is falling out of global growth and we're going to see a recession, and that's what these moves are very much edging us towards. A 15% decline year to date in the NASDAQ suggests that there's a decent chance of a recession. And actually Bloomberg has now put that up to 50% for the US. So really something to watch there, with kind of real economic pain for the whole of the global economy, but particularly for the US as well. Very much a Pyrrhic victory. No one's winning, basically, from this trade war. But when you get moves of that size, it does suggest that there's a recession likely. So we are really seeing a rapid recalibration of expectations for global growth, expectations for monetary policy loosening as well. I'll bring up another chart very, very quickly, because I know that we are here as well to talk about what's going on with payrolls, although they seem terribly out of date. But this is a work chart, so a world interest rate probability chart. So this is calculated using Fed funds futures. So the market's now expecting interest rates in the US to end the year at 3.16%. I just want to show you how mad this is. 2 days ago, the expectation, sorry to let it load, was that they would end the year at 3.55%. So you've had this massive move, and basically a whole other 2 interest rate cuts now expected, just under 2 rate cuts expected for the Federal Reserve this year. Likewise in the UK and in Europe as well. ECB is expected to cut rates, and that is going to weigh a little bit, I think, on the euro and the pound, because they have had such strong reactions to what's been going on. Now let's come back into just looking at this work chart, as you can see, lots of cuts now priced in down here, and we'll be watching to see very, very closely what happens there. Now, just before I forget, I don't want to forget, because of course today is payrolls day, and that's why we're here. I'm going to run through this really, really quickly, and of course we'll look at it as it comes out live. But just to remember, this is March data, so this is from last month. I wouldn't say discount it, that's not what I mean, but it does not reflect the reality that we're in and have been in since Wednesday night. But on that note, change in non-farm payrolls, market's looking for 140,000. The unemployment rate is expected to remain steady at 4.1%, and average hourly earnings annual growth is expected to also remain steady at 4%. So some pretty all-round solid figures. Considering what's going on in financial markets, you wouldn't expect 140,000 increase in payrolls. The risk is, of course, is that number goes much lower or even negative in the next couple of months. Now, there is a risk, an upside risk to this 140,000 figure. Usually that would be great news for the dollar, bad news for bonds, great news for stocks. We don't think it will be this time around, because there is another theme that's dominating financial markets, which is the Trump trade tariffs. And instead, what we think it will do, it will just be worth kind of keeping an eye on. We think that the 140, we've heard the word on the street could be 160, 175, and it's largely down to unwinding of some weakness that we saw at the start of the year because of weather-related events and those fires in Los Angeles and in California. So these California wildfires, some other weather events last month, they should be in February, they should be unwound in March. So even if there is an upside surprise, we don't think that will be enough to placate markets. What we think will more likely placate markets and help put a floor maybe under stocks, because there doesn't seem to be one. President Trump doesn't seem to be too interested in having a stock market put. Instead, he's looking very closely, as he says, on the 10-year yield, and that is falling like a stone. Just to remind you guys, yeah, the 10-year yield in the US, remember it had been, let me just put that up for you. The 10-year yield is now well below 4%. So it had been well above 4% before Trump started talking, and it's now currently at 3.8%, 4.4% for the UK, 2.4% for Germany. So they have come off a hell of a lot. In the UK, just in the past week, and really those moves have been mostly over the past 2 days. We've seen a 25 basis point drop in the 10-year yield. Now, we're going to see big drops. That's a 31 basis point drop for the US and a 24 basis point drop for Germany. And we're going to see those big drops because essentially the yield curve is flattening. And when that happens, it's a real sign of an inverted yield curve. We're probably not inverted yet, but when it moves in that direction, it is suggestive of recession territory. So for quite a while, actually, we had pretty low yields. They didn't suggest a recession, or certainly didn't lead to a recession. But now, when growth had just finally started ticking along and was actually very strong in the US, it does look like that's what this is signaling. So some real historic moves in financial markets, guys. It is hard for all of us to get our heads around just how quickly things have changed. I'm just going to go back to the commodities page. We have seen a bit of a pickup now. Brent crude is just above 65. That's interesting ahead of this payrolls report. Be interesting to see if there's a bit of front running, maybe a stronger payrolls report could just have a small amelioration effect on financial markets and on risk assets in particular. Now, when we look at how stock markets are doing, something else I wanted to show you as well was just the S&P 500 E-mini future. So this is US markets obviously aren't open right now. They'll open in just over an hour, but this just shows you the futures. Again, they were ticking along really nicely, and then they just absolutely fell off a cliff once we got that China announcement. So expected to open down 150 points. That would probably be somewhere, I'm going to guess, at around the 3% mark. So yeah, not looking good there either. And another heavy loss for the US. But it is interesting just to watch. And I think that move in oil could be that the US economy is actually maybe a stronger payrolls report would suggest that we have it coming off a stronger base. We've got a stronger base to be able to suck up all of these extra tariffs, but without a doubt, a massive move in risk assets. I mean, it's just been crazy. So again, the pound picking up a little bit here as well, which means the dollar is weakening. I would imagine that is across the board. Let me just go on to a short-term daily chart for euro as well. Yeah, euro is picking up too. So going back towards those highs at 111 for euro dollar. We're just going to move now to, we're 30 seconds away now from the payrolls. As I said, 140 is what we're looking for. I think some of the price action in markets is just a sign that there might be some expectation of a slightly higher than expected number. I don't think that will have a long-term impact on what stock markets do. I still think that stocks will perform very, very badly. Private payrolls, they were weaker than expected anyway. And we saw much weaker employment in the ISM service sector survey for March, which came out yesterday. So really mixed picture. 3, 2, 1. What is the number? 228. Well, there you go. So it is much stronger than expected. But we have seen an increase in the unemployment rate to 4.2%, which is pretty sharp. We've also got average hourly earnings falling, so 3.8%. So some good news in this report. It is still very out of date. A much stronger private sector payrolls, 209,000, 228 here for the change in payroll. So much stronger than expected. And we did say that that was a possibility because of all of those distortions. And we did see the February figure revised lower to 117. So part of that is actually making up for those jobs that were lost because of those weather events at the start of the year. Let's take a quick look to see what is happening. We'll take a quick look at euro. Euro's bounced back. Yes, the dollar is climbing there because that's a much stronger than expected payrolls report. Remember, anything above 200,000 per month is a real sign that the US economy is just booming. So we're getting these really mixed messages. So the hard economic data was still very strong. This is a key hard economic data point for the US, the labour market report. We've seen much softer with much softer data for the softer economic data. So all that sentiment data, that consumer confidence, that's been very, very weak. So we've got this contrast. And then, of course, you've got this absolute mess going on in financial markets, and staggering moves in financial markets is what I should say, on the back of expectations about what Trump's tariffs will mean. So we've got a much stronger labour market report, but what does that mean going forward? Not very much, because potentially we could see jobs being absolutely slashed as panic sets into markets. Now, a couple of things to note. Jerome Powell is talking later today. It'll be about 4:45 UK time. That's worth noting because he does have the power and the ability to calm financial markets. He's done that. Now, what would be the best way to calm financial markets right now? Number one, obviously a reversal or rowing back from some of Trump's announcements during the week. Maybe the firing of Howard Lutnick or Peter Navarro, who's the architect of this Trump tariff strategy. Now that some of the maths behind the calculations in the tariffs has come under a bit of scrutiny. You may have seen a bit of that online. If you haven't, I would actually go and look because it is quite interesting and funny. The other thing that would calm markets is our emergency rate cuts. Now, I would not be surprised to see that because nothing would surprise me at this stage. If you'd said that, if someone had asked me that 48 hours ago, I would have said, no, not a hope. There's no way they'll get involved in that. They're too worried about inflation. Well, now I think the Federal Reserve is going to be very, very worried about growth. And that's because even with this much better than expected economic data, just go back to the payrolls page, 228,000 in payrolls, even though it's much, much better than expected, I still think that there's a whole lot of pain coming for the economy through these tariffs. So that's something certainly to watch. Now, we're not seeing too much movement in bond yields there. We're just going to look at the dollar index here. Again, it's fairly quiet for now. And yeah, I still think that stocks, even though they might climb a little bit, I think they'll still remain under pressure. In terms of oil, well, that move had already happened. So as I said, leading up to that payrolls report, we had seen a move back above 65 dollars per barrel, but it is still down 6.67% on the day. That's for Brent crude oil. Again, I think it's amazing that gold as well is falling. So gold is moving a little bit higher on the back of this data. So it's now down only $20 on the day, trading at 3094. Remember when we first started talking, it was trading around 3093, but it is very volatile. So it's moving very, very quickly. This is real whipsaw price action, but very much on the downside, whipsaw price action for now. Let's take a look at volatility as well to see where we are ahead of US markets opening in just under an hour now. Volatility is backed off a little bit, but it's still at really elevated levels, guys. So it is, be careful, make sure you've got your stop losses, make sure that you're, following our analysis so you know driving markets. It's very headline driven. So we could see a complete reversal if we get any of those things, maybe an emergency rate cut from the Fed, or if we were to see the Trump administration roll back on anything. I do think this economic data is going to make it a little bit hard for a near-term emergency rate cut, but these moves in markets, as I said, are staggering, and they could cause some real economic pain and lead things to spiral and get worse. So there is a case for them to make that on the back of this, but I'm sure the Fed would much rather that Trump reversed on some of his plans, or maybe shakes up his economics team and his trade policy team. But guys, I'm going to leave it there. This has been a really historic day. I'm sure you're all really ready to get going and enthused by financial markets. If anything, these are interesting times. They're historic times. So good luck trading, and we look forward to you joining next time. Thank you.